World equity markets continue their early year strength. The Dow Jones up again today. The index is now up 1.7% so far in 2023. It's bringing up the rear of the major indexes. The S&P 500 doing a bit better, up 2.1%. And the NASDAQ is up 2.5%. The leader is the Russell 2000, which is up 3.5% on the year. Now, one of the reasons that you're seeing more strength in the S&P than in the Dow is we have gotten a bid in some of the beaten down stocks, but the fact that those types of stocks are the ones that are leading the rally, basically the most overvalued, heavily shorted names are the ones that are rallying. To me, that indicates the unsustainable nature of the current rally when all you have is short covering and maybe some speculators trying to get in for a quick buck and ride these stocks up. For example, the Cathie Wood ARK Innovation ETF is up 7.6% so far this year. That likely means that when the momentum runs out and then in fact turns, that these stocks are going to come crashing down for new lows and likely take the major indexes down with them. But a continuation of the trend from last year, foreign markets are outperforming. Foreign stock markets are doing better than the S&P 500. And in fact, the best performing stocks of all are the gold stocks. That continues. The GDX, as I'm recording this podcast after the market closed on Tuesday, is up 11% on the year. The GDXJ, which is the junior miners, is up a little bit more, up 11.3%. Gold itself is up 3% so far in 2023. It closed Tuesday at about 1788. That's a 3% gain on the year. That's better than the S&P 500 or the NASDAQ. It's only lagging the Russell 2000. But if gold and gold stocks are the top performers, that doesn't indicate that you have a healthy market. And in fact, maybe we're going to get a reality check on Thursday when we get the release of the December CPI. That will be the last read on domestic inflation for 2022, and there is some continued optimism that we're not going to get much in the way of inflation. The expectation is for an unchanged reading during the month for the headline number, and the core ex food and energy is supposed to rise by 0.3. The year-over-year rise in the CPI is supposed to come down from 7.1 in November to 6.6 in December. And ex-food and energy is supposed to drop from 6.0 in November to 5.7. Now, if we don't get that type of reduction in the official inflation numbers, that could send the market into a tailspin because everybody is hanging their hat on the fact that inflation is going to come down in 2023. And because inflation is going to come down, the Fed is not going to have to be as aggressive as many people suspect. The Fed will be able to ease up on the rate hikes. And in fact, if enough progress is made on inflation, many people expect the Fed to reverse course and begin cutting interest rates before the end of the year. Now, I agree with that camp. I think there is a good chance that the Fed will cut rates. In fact, there's probably an even better chance that they will go back to quantitative easing, whether they cut rates or not. But I do expect the Federal Reserve to ease policy in 2023, but not because of a victory in the war against inflation. No, they're going to surrender. Inflation is going to win that war. The Fed's going to run to fight another battle. At least it's going to try to fight because it's going to lose that battle too. And that battle is going to be recession, maybe financial crisis, maybe a battle to try to prop up the U.S. government, whose insolvency is becoming a bigger problem with rising interest rates. In fact, I looked up on the national debt clock, and as of right now, the national debt is about to hit $31.5 trillion in 2023. That's another reason that the Federal Reserve is going to back off of its rate hikes and, in fact, may have to go back to quantitative easing because they will need to buy treasuries that private buyers don't want at interest rates that the U.S. government can't afford. But while I'm on the topic of credit and debt, We got the consumer credit numbers for the month of November that were released yesterday. And we had another huge increase in credit card debt in particular. Total credit card debt is now $925 billion, or at least it was at the end of November. And that's just $2 billion below the all-time record high, which was set in the fourth quarter of 2019 at $927 billion. But back then, the Fed still had interest rates at zero. So credit card rates were also a lot lower. As of the end of November, they hit an all-time record high. The average credit card interest rate is now 19.6%. That's the average. So obviously some people are paying higher than 20%. So we have near record debt, but we have record high interest rates. And of course, I'm sure that we have record debt by now because it doesn't count the debt from December. And that was when a lot of consumers had to buy Christmas presents or take vacations. And I'm sure the cost of a lot of that travel and those gifts were put on a credit card. So I'm sure we're at all-time record highs. In fact, sometime in 2023, I expect credit card debt to surpass $1 trillion. But what's also a big deal about this increase, and the year-over-year increase is 15%. That is the biggest year-over-year gain in credit card debt in 20 years. And in fact, if you look at total consumer credit, it's up 16.9%. And I think this is understating it because a lot of consumers have been taking advantage of buy now and pay later. And I don't even know if that counts as credit. I know that those buy now, pay later companies are not reporting to credit agencies the amount of money that their customers have committed to pay later. And in fact, if it wasn't for the proliferation of all these buy now and pay later companies, I'm sure credit card debt would already be a lot higher because a lot of the merchandise that was purchased using that gimmick would have been put on a credit card. And the irony of it is most of these buy now, pay later companies, when it comes time to paying later, you end up paying on your credit card. So all these buy now, pay later companies, when it's time for the consumer to pay, all those charges are going to end up on credit cards. There's just a delay between the time the consumer buys something and when the amount that he owes shows up on his credit card. But the more significant issue here is not just that all this additional consumer credit and debt is indicative of a weak economy. It's also indicative that the Fed is losing its battle against inflation because the Fed has to rein in credit. The Fed has to raise interest rates in order to restrict credit. That's the purpose of these rate hikes. Again, what the Fed needs to do is discourage people from spending and encourage people to save. That's the purpose of these rising interest rates. But that's not happening. The Fed is raising interest rates, but consumers don't care. They're just borrowing more money and spending more money. So this credit supply is expanding, and that's going to continue to put upward pressure on prices. The Fed is making no real headway in its battle against inflation. All that we've seen is a temporary correction in commodity prices, a downturn in house prices, but beneath the surface, the inflationary forces are as strong as ever. In fact, they're getting stronger. And so all these people who are expecting a meaningful reduction in the inflation rate in 2023 aren't going to get what they expect. After a brief downturn in the official numbers, we're going to see a surge as consumers continue to spend borrowed money, but more importantly, as the dollar tanks, putting huge upward pressure not only on commodities, causing a reversal and a run to new highs, but on the record level of imports, because everything America buys, and of course most of the stuff, the merchandise that we buy is made abroad, all that stuff is going to get a lot more expensive as the dollar falls. And the other reason, of course, that people think that inflation may come down in 2023 is they think the unemployment rate will go up. And they expect a rise in unemployment to bring down inflation. In fact, many people still think that's the Fed's goal, that the Fed's plan is to fight inflation by fighting employment, by causing an increase in unemployment, by causing a slowdown at the rate at which wages are rising. People think that rising wages cause inflation, and so the Fed needs to slow down wage growth with its rate hikes. But rising wages don't cause inflation. In fact, looking at wages going up and concluding that's the reason for inflation is like somebody who's sick and they have a fever, and so they take their temperature with a thermometer, and then the thermometer says 102, and they blame their fever on the thermometer. Well, it's not the thermometer's fault. It's just reflecting your temperature. Well, that's the same thing with wages. Rising wages aren't causing inflation. Inflation is causing wages to rise. So the wages are simply taking the economy's temperature when it comes to inflation. Now, you can't fight inflation by trying to stop wages from going up. That would be like trying to fight your fever by smashing your thermometer, or maybe lowering the reading by putting the thermometer in a cup of ice water. That's not going to work. If you ignore the underlying illness and just try to cover up the symptoms or deny they're there, then you're going to get sicker. The same thing is going to happen with inflation. If the Fed is thinking that rising wages are the problem and it tries to solve that or cover that up, then the underlying actual problem that is causing wages to go up is going to continue, and that's inflation. And in fact, the reality is, to the extent that the Fed does succeed in putting people out of work, that is actually going to be inflationary, because people are going to stop working, but they're not going to stop spending. They're going to continue to have access to money either through the government or through credit cards, and they're going to keep on spending, fueling demand, but they're not going to be producing, and so you get less supply of goods and services and you get more demand.